Welcome to TalkTickers.
Great to be here.
You're tuning in for our deep dive into the latest earnings call from a major player in the out-of-home advertising space.
Yeah, and our mission today is pretty straightforward. Cut through the noise, extract those crucial insights so you can quickly get a handle on what's driving this company.
Okay, sounds good. Let's kick things off with the headline numbers. What did the snapshot look like?
Right, so big picture.
Yeah.
This marks their 16th consecutive quarter of acquisition-adjusted revenue growth.
16, wow.
Yeah, quite the streak. It was up 1.1% this quarter, and adjusted funds from operations AFO per share, that's a really key metric here, saw a nice jump.
How much?
Up 3.9% to $1.60 per share. They're also, importantly, sticking by their full-year AFO guidance.
Okay, what's that range again?
They're projecting between $8.13 and $8.28 per share for the full year.
Got it. Anything else major from the top level?
Two other things stand out. A pretty significant share repurchase, $150 million worth of stock bought back in March and April. And they're forecasting full-year capital expenditures, or CAPEX, to land around $195 million.
All right, a solid overview. Now, let's dig a bit deeper. Beneath those main numbers, how did they actually achieve that growth? Sounds like there were some interesting dynamics in where the revenue came from.
Absolutely. There were definitely some moving parts. So local and programmatic revenue, those were up.
Good signs there.
Definitely. But national revenue actually saw a slight dip compared to last year.
Why was that?
Well, they gave some important context. Remember, Q1 last year had that extra leap year day.
Ah, right.
And maybe more critically, the Super Bowl was hosted in Las Vegas, which happens to be their biggest airport market. So that set a really tough comparison for national revenue this year.
Okay, that makes a lot of sense. Those are definitely unusual factors. But let's talk about those growth areas you mentioned. Programmatic.
Yeah, programmatic, that's the automated buying and selling of digital ad space, was a real bright spot.
How great.
Grew by about $2 million. That translates to nearly 30% growth.
Wow, nearly 30%. That says a lot about their digital push, doesn't it?
It really does. It shows they're getting, increasingly savvy with leveraging tech for ad sales. And it wasn't just programmatic overall.
Oh.
Their specific digital billboard revenue climbed by 4%. That part of the business now makes up roughly 30% of their total billboard revenue.
So a significant chunk.
A very significant chunk. And even looking at the same set of digital boards year over year, what they call same board digital revenue, that saw a slight increase too. Suggests those assets are just becoming more valuable over time.
Interesting. And what about different advertiser categories? Any particular industries spending more or less?
Yeah, that definitely tells a story. Services were strong, up 11%. Retail up 6%. Construction saw a nice jump, up 15%, and oil and gas was also strong.
Okay, so some solid industrial and service growth. Where was the weakness?
Relative weakness was seen in gaming, which was down about 9%. Restaurants were down 4%, and the amusement category was also a bit soft. It gives you a feel for where ad budgets are flowing right now in the out-of-home world.
Right, a real-time pulse on the ad market.
Exactly. And another really key theme here is the consistency of local and regional sales.
You mentioned that earlier, still strong.
Very strong. It makes up about 82% of their billboard revenue. And like we said, it's grown now for 16 straight quarters.
That really underlines the stability of that core local business.
It does. It seems quite resilient. And interestingly, their other divisions, airports and logos, actually did better than the main portfolio revenue, grew 2.8% and 2.3% respectively.
And geographically, any differences?
Yeah, a little bit. The Central and Midwest regions showed relatively more strength. The Southwest, which includes Las Vegas, probably feeling that Super Bowl comp.
Right.
And the Gulf Coast regions were comparatively weaker this quarter.
Okay, let's shift gears a bit. How are they expanding their physical footprint? M&A sounds like a big part of the story.
It is, and increasingly so. They closed 10 deals just in Q1, spent about $22 million.
Just Q1?
Just Q1, and they've done more since then, including buying a portfolio with a good digital presence up in the Northeast.
So they're staying active.
Very active. In fact, their year-to-date M&A spending is already over $70 million. And they sound pretty confident about blowing past their original $150 million projection for the year.
Really? How high do they think they'll go?
They're now thinking potentially over $200 million for the full year.
That's a significant bump in ambition.
It is. And they describe these deals as predictable, high-quality assets. Importantly, they're within their existing geographic footprint, so it seems like a disciplined way to build scale.
Makes sense. Okay, let's pivot to costs and profitability. How did expenses look?
Well, acquisition-adjusted consolidated expenses were up 2.6% in Q1. That was actually a little better than they'd anticipated.
Okay, any specific reasons for the increase?
Yeah, a few things. They mentioned costs related to an enterprise system conversion, higher health insurance expenses, which a lot of companies are seeing,
Sure.
and some one-time sales commission costs because of a sales contest they ran in Q1. There were also some non-recurring regional outdoor expenses in the quarter that they don't expect to repeat.
So some temporary factors in there. What about overall profitability?
Their adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization, came in at $210.2 million. That was slightly down from $211.9 million last year.
Okay.
But their adjusted EBITDA margin is still quite strong, around 41.6%. So the underlying profitability looks pretty robust.
And looking at the balance sheet, how's their debt situation?
Looks pretty comfortable, actually. They've got a well-laddered debt maturity schedule. Nothing significant coming due until 2027.
That gives them breathing room?
Exactly. Total debt is around $3.2 billion. The weighted average interest rate is manageable at 4.6%, and the average time until maturity is 3.6 years.
And leverage?
Quite low. Net debt to EBITDA is just 2.85 times.
That is low. Gives them a lot of flexibility.
It really does. They mentioned having over $1 billion in investment capacity while still keeping leverage below their target range, which is 3.5 to 4 times net debt to EBITDA.
So plenty of dry powder for more M&A or buybacks.
Seems like it. And their liquidity position is strong, too. Over $490 million available at the end of the quarter.
Okay. And we touched on the share buybacks earlier. $150 million, that was a decent chunk.
It was. 1.39 million shares bought back at an average price just over $180 per share.
And are they planning more?
Looks like it. They have $100 million left under the current authorization, but they plan to ask the board to bump that back up to $250 million.
So a clear signal they think the stock's a good buy.
That's usually the interpretation. They specifically mention the repurchases are accretive to AFO per share, meaning it boosts that key profit metric for remaining shareholders. It's a way to return capital and signal confidence.
Right. Now, looking ahead, you said their full-year AFO guidance is unchanged. Any finer points on that outlook?
Well, interestingly, that $8.13 to $8.28 guidance doesn't yet factor in the impact of those recent share repurchases. So you could argue that's a bit conservative.
Okay.
They're projecting cash interest for the year at $152 million, assuming SOFR, the benchmark rate, stays flat. Maintenance CAPEX is budgeted at $60 million, and cash taxes around $10 million, though that excludes any taxes related to the sale of their Vistar Media business.
Got it. And what about those digital billboards?
They expect to beat their goal of deploying 350 new ones this year. So, continued investment in digital.
It sounds like they're navigating some softness in the national ad market, though.
Yes, they did acknowledge that. They pointed to maybe some changes in customer buying habits and also some turnover in CMO roles at client companies, which can disrupt spending.
But programmatic is helping offset that.
Partially, yes. That strong programmatic growth is definitely a cushion. And they also said feedback from their big agency customers suggests a broadly steady outlook.
And how do they see out-of-home holding up if the economy gets shaky?
Management emphasized that historically, out-of-home advertising has actually been pretty resilient during periods of economic uncertainty.
Interesting point. Okay, finally, let's talk dividends. How are they returning cash directly to shareholders?
They paid out $1.55 per share in Q1.
And for Q2?
They plan to recommend the same amount, $1.55 per share, to the board. Their overall policy is to distribute 100% of their taxable income.
So what does that mean for the full year?
They expect the regular dividend to be at least $6.20 per share for the year. And that's before considering any potential extra distribution from that Vistar sale we mentioned.
Okay. So wrapping this all up, what are the sort of key takeaways for anyone watching this company? That consistent local and regional strength seems like a big one.
Absolutely. It really anchors the business and it maybe differentiates them. You also see management's confidence shining through with the stepped up M&A and the share buybacks.
Right, putting their money where their mouth is.
Exactly. And that solid balance sheet, the low leverage, the strong liquidity, it just gives them a lot of flexibility for whatever comes next, whether it's more deals or, weathering economic bumps.
And don't forget the digital side. The growth in programmatic and digital billboards shows they're adapting.
Definitely. They're not standing still. One other small point, they mentioned legal services becoming a more prominent, consistent driver within that broader services category. Could be a sign of another reliable revenue stream developing.
Interesting nuance. Okay, now for our favorite part. This is not financial advice segment. Got any outrageous but plausible trade ideas based on this call?
Okay, outrageous but plausible idea number one. Given how aggressively they're buying back stock and management explicitly saying they think it's undervalued, you could consider a long position in the stock. But here's the twist. Set a really tight stop loss just below that average $108 repurchase price they mentioned.
Okay, what's the thinking there?
The thesis is that management's conviction, backed by actual buybacks, might create a sort of floor under the stock. The continued buying could potentially nudge the price higher as the market catches on to the value they see, is playing off their own actions.
Interesting. A technical play based on management signals. Okay, number two.
All right, idea number two is maybe a paired trade. We heard construction and oil and gas were strong sectors for their advertising.
Right.
And they're active acquirers in their space. So maybe you go long this out-of-home company, but at the same time, you short, say, a major national television advertising company.
Why TV?
Because TV advertising might be more vulnerable to economic downturns or those shifts away from big traditional national campaigns that the company hinted at. You're basically betting on the specific strengths highlighted in this earnings call: local resilience, specific sector strength against potential broader market weaknesses elsewhere in advertising.
Leveraging the specific against the general. I like it. Outrageous, but plausible.
Exactly. Emphasis on plausible. Maybe.
All right, that wraps up our deep dive into this latest earnings call. We've hit the key results, dug into the trends, and even tossed around a couple of speculative ideas.
And just to reiterate, this isn't financial advice. Always do your own homework.
Absolutely. Hopefully, this gave you a clearer picture of what's happening beneath the surface. What stood out most to you in this report? What questions do you still have? We'd genuinely love to hear your thoughts.